Hello everybody, I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. I wanted to touch base with all of you and review the quarter that just ended and discuss some of the risks and the rewards, in our view, that are awaiting for the rest of the year. Let me start by saying that we are living in an extreme environment of risk and uncertain times. The average stock on the Nasdaq is down about 47%. The average stock on the Russell 2000 is down about 39%. Half of the S&P 500 is down 20% or more. We are in a bear market, which by definition is any decline in the market north of 20%. In our view, we are also living in times of stagflation, a slowing down economy, together with higher inflationary pressures. CPI numbers, the Consumer Price Index numbers, are up 7.9% year over year. However, the essential items in our economy, such as the price we pay at the supermarket for milk, bread, oil, energy, shelter, is up 16% year over year. These are not easy times for the average consumer. 10% of our discretionary income is spent only to keep up with the lifestyle that we were used to just before these inflationary pressures came about. The yield curve in most days is inverted. The 2-year is paying in most days more than the 10-year and the 30-year Treasury bond. The 5 and the 7 years are paying more than the 10, the 20 and the 30-year Treasury bonds. Inverted yield curve is an indication of some sort of a slowdown or a recession coming in the next 12 to 18 months. Oil prices are up in most days to over $100 a barrel. 1/10 of the oil production, about 2 million barrels a day, is coming from Russia, and there is the possibility that more sanctions are going to be imposed, and therefore prices can definitely keep on going up. Also, Russia and Ukraine are the largest exporters of wheat and corn. A quarter of the corn supply and 1/5 of the wheat supply can be off the market, causing prices to keep on going up. 3% of the discretionary income is spent on energy. Now, we can see some slowdown happening already, even by just listening to the Federal Reserves. In the fourth quarter of last year, GDP growth rate in this country was 7%. It is estimated by the Federal Reserves to go down to 2.8% this year, and by 2024 to 2%. The Atlanta Federal Reserve Board even is predicting 0.5% growth rate, almost a stall growth rate for our US economy. In addition, the Federal Reserve is on course to raise short-term rates this year to 2.5%. They were communicating to us that their plan is to raise short-term rates by 50 basis points in May and another 50 basis points in June and 25 basis points in every month thereafter. And they are raising these rates into a slowing down economy. By them doing that, they are inverting the yield curve. Every 25 basis points raise in interest rates narrows the spread between the 2-year and the 10-year by 10 basis points. Let's assume that the Federal Reserve will continue raising rates. By their actions, they will invert the yield curve, most likely. In addition, the real estate market, which was up nicely year over year at a rate of 18.8%, can also start slowing down. 30-year mortgage rates are up to 4.5% and even 5% in some markets. A loan for $125,000 to buy a house will cost consumers at 4.5% to 5% mortgage rate about $300 more every month. In different markets across the nation, we see that affordability dropped by 70%. In some markets, like in Texas, there is only 6% affordability rate to buy new homes. The pace of increase in home prices is by far exceeding the pace of increase in income in 82% of all real estate markets across the nation. A slowdown in real estate can have a ripple effect on the US economy. If we look at some of the fundamental indicators in the market, when we see the rate increase in long-term interest rates plus the rate increase in oil prices exceed 100%, which is just about the case right now, that by itself is another indication for some sort of a slowdown and a recession to come. Additionally, in the last 11 US recessions, the S&P 500 dropped about 26%. If we were to take the recent market decline divided by the 26%, it's fair to assume that there is a 50% probability of a recession in the near future, 12 to 18 months out. So although we think that there is a very high likelihood that markets will try to retest the previous low, I must tell you that history, in my view, is on our side. Since 1998, the Nasdaq had 17 instances where 30% of the stocks dropped to their 52-week low. A similar situation that we are witnessing right now, where about an average stock on the Nasdaq is down 47%, and the index from its previous high is down more than 20%. And I have to tell you that in each case of these last 17 instances since 1998, 12 months later, the average, or should I say the median stock on the Nasdaq, was up 12 months later, 47%. I should also tell you that since 1972, when the Nasdaq was created, 3/4 of the time, when that index was down 20% or more, which means it traded in bear market territory, about 10 months later, the index was up about 10%. So there are a lot of positives still in the marketplace. And let me name a few. Number one, the job market in the US is still extremely strong. We have 3.6% unemployment. Job creation is running at about 700,000 new jobs every month. Wages are up 5.7%, not in real terms, but are up. Savings rates are at $3 trillion, and 60% of all individuals are still able to save that money without spending it. The cumulative net worth of all individuals living in the US, which includes the real estate holdings, the 401ks, the IRA accounts, is up just in the last 12 to 18 months, 37% to $140 trillion in total. That by itself should provide some sort of backstop and confidence level for individuals to continue going about their lives and buying and spending. Additionally, it might not be that the yield curve is inverted. Some will say that the true inversion is not reflective of the reality that the federal government purchased about 25% of all treasuries since the pandemic started. Also, some will say that because the Federal Reserves more than doubled their balance sheet to $9 trillion since the pandemic started, the long end of the curve is distorted and should be about 1% higher or more. There is no doubt in my mind that the stock market as an asset class outperformed any other asset class in the marketplace, which includes real estate, bonds, cash, securities. In fact, since 1972, the stock market on average was up north of 16% as opposed to the real estate market, which was averaging about 5.5% a year. And since 2012, on average, indexes were up about 16 to 17% as opposed to the real estate market that was averaging 7.5%. There is scarcity of asset classes to put money to work, especially in companies that can outgrow inflation rate. And when these asset classes and individual stocks exist, money, in my opinion, will rotate back into the market. Now let me conclude by saying a few things about the technology sector that we invest in with many of our different investment strategies. I'm super excited about the future. We are living in the fourth industrial revolution in technology. Computers understand us better than human beings. Companies like Google that we invest in, for example, are working on technologies to break the natural language processing barrier, the same barrier of the image recognition that we broke already. And in their platforms, they have already 1.6 trillion parameters, doubling every 2.5 months' time, which means by the end of 2023, some of these platforms will have 100 trillion parameters in them, equivalent to the efficacy of the human brain. And that is the artificial intelligence revolution. We are also living through the augmented reality revolution, the Metaverse. We are no longer just connecting to the internet. We are living inside the internet. And lastly, we are also living through the Internet of Things revolution, the 5G revolution, the autonomous driving revolution. which will change everything about the way we live, communicate, and socialize with one another. My expectations for the future are bright and strong, and I'm excited about these dislocations in the marketplace. In my view, these are just additional opportunities for growth prospects for us in the near future. So we will have our eyes opened, looking for buying opportunities to take advantage of all the recent market sell-offs. And therefore, I do believe that this bear market and stagflation and an environment of rising interest rates shall pass as well. Thank you for listening.
Overall inflation numbers recently were reported at a 40-year high of 7.9% year over year, meaning that more of our paycheck dollars are dedicated to essentials, leaving less for discretionary spending. A pullback in discretionary spending leads to a stagnating economy that, coupled with inflation, is a state in the economy called stagflation. A slowing economy combined with rising costs certainly can lead to market volatility as we have been experiencing. The Federal Reserve, whose job it is to contain inflation, will use interest rate increases to calm inflation and slow down the economy. Jerome Powell, the chairman of the Federal Reserve, has communicated and on Monday implemented the first of several planned rate hikes, raising the Fed funds rate by 25 basis points. He also communicated that an additional 6 interest rate hikes are scheduled for the remainder of 2022. The challenge this presents is that if the Fed raises rates too much, too fast, they could cause an inversion in the yield curve. An inversion occurs when interest rates on short-term treasuries yield a higher rate of return than longer-term treasuries, particularly with respect to the 2-year versus the 10-year. This type of inversion has oftentimes been a precursor to a recession, with the average recession beginning 6 to 18 months after the inversion begins. As of now, the 2-year and the 10-year have not inverted, and the Fed has communicated that they feel confident in orchestrating what's referred to as a soft landing, which basically means that they will not invert the yield curve. As of this taping, the spread between the 2-year and the 10-year has flattened to 17 basis points, but still has not inverted. Here at Tamar Securities, with its subsidiaries 911 Financial Services and Firefighters United, we employ 13 different investment disciplines, from the most conservative to the most aggressive, that have weathered just about every conceivable market condition over the past 3 decades. Rest assured that our home office team in Woodland Hills is monitoring these developing market conditions on a daily basis.
The news cycle may seem as if the main factor affecting markets is the Russia-Ukraine conflict. However, the main narrative driving the market is red-hot inflation and the 2 mandates of the Federal Reserve, the most pressing of which is price stability. You've already heard, year-over-year inflation has risen by 7.9%, the highest since 1982. Of course, this has deleterious effects on Main Street, but what does it mean for your investments? Despite inflation being labeled a high-class problem, it affects all market sectors differently. Let's look at the short and long-term impact of inflation and subsequently higher interest rates on technology names. It's typical of technology stocks to sell at higher multiples versus other sectors. This can make technology companies vulnerable in a rising interest rate environment like the one we're entering into due to inflation. Higher rates mean that earnings years from now are worth less today. The further into the future earnings are expected, the companies become devalued in comparison with bonds issued with the full faith and credit of the US government. After technology stocks are repriced in response to increased interest rates in the short term, we need to be forward-looking, 6 to 12 months out, on how these names will perform versus those in other sectors. The reason that technology companies can increase in value in an inflationary environment is because they're intrinsically efficient. While companies in other sectors are seeing prices increase for goods upstream in their supply chain, the technology sector has a better ability to pass on input costs to customers. These companies also have relatively low labor costs to sales ratios. The cloud model is particularly suited to absorb and pass costs to customers. Proof positive lies in the earning results for the big 3 cloud providers. In the latest Q4 of 2021, Microsoft Azure, for example, grew 46%. Google Cloud grew 45%. Amazon AWS grew 40%. Clearly, inflation did not dissuade customers from expanding their usage of the cloud, and rather it drove them to double down on their usage. profit margins are another reason technology companies will perform well in an inflationary environment. They're unencumbered by the inflationary effects on costs because they can more easily absorb increases in input costs. The reason is that they command higher margins relative to companies in other sectors. So what does the future look like? Technology companies are the first to recover when they're the first to sell off. Past performance is no guarantee of future performance. However, we have seen that since its inception in 1972, after falling into a bear market, the NASDAQ has averaged a 10% increase in 6 months afterwards, 2/3 of the time. It's this forward-looking strategy that we're following in precise detail to navigate a market highly affected by inflation.